Hello and welcome to episode 99 of the Remarkable Results Radio's Town Hall Academy. We have a very interesting look at the new 2018 tax law and the implications on the service professional. You won't want to miss this discussion. Now here's a taste.
It's still going to be around for at least another 5 years, but it's not going to feel like new money after this year. It's going to become the new normal that you're used to.
Save for a rainy day, retirement, paying down debt. Absolutely great ideas.
Welcome, automotive aftermarketers, to a Remarkable Results Radio Town Hall Academy. Listen to learn just one thing from today's episode on your journey to remarkable results.
Hey, Carm Capriato here. Welcome. Now, thanks to Gerry Frank, you are going to learn some interesting facts about the new 2018 tax law and how it can affect your business. This episode is not intended to give advice on the tax law or accounting principles, so please check with a professional for all your tax and accounting requirements. Hey, I want to thank the supporters of the Town Hall Academy, Jasper Engines and Repair Pail. Now, in addition to the strict quality remanufacturing steps they take at Jasper, they can actually improve a drivetrain's components' original design so that it runs longer and better than when it was new. Check out their featured engine and transmission pages at jasperengines.com. You know, once a shop passes Repair Pail's certification, they post results from unbiased customer satisfaction surveys on your shop profile. Photos, models serviced, and other shop details improve your SEO and help customers find you. Learn more at repairpail.com/shops. Hey, I'm handing out some podcast swag during December 2018. Go to this special web address, remarkableresults.biz/swag, and enter the special password. Where will you find it? Well, you'll hear it in this episode. So if you want a shot at a collector's coffee mug and mousepad, listen for the special password and then enter. Are you listening to the podcast on a mobile device? Well, then great. Thank you very much. And if you're not listening mobile, then you can find a listening app on my website at remarkableresults.biz/app. There you can not only download my own listening app to your Android or Apple device, you can discover another 12 sites that offer the podcast. Learn to enjoy the remarkable content found only here while you're commuting. Now, let me introduce you to my panel. Reed Melis, financial therapist and partner in Paar, Melis & Associates, Mount Airy, Maryland. Hunt Demarest, CPA, also at Paar, Melis & Associates, and shop owner Gerry Frank, and business coach at Repair Shop Coach. We bring into perspective some of the highlights of the new tax law and how those changes may relate to your business as service professionals. Reed and Hunt's accounting firm specializes in the service professional, and Gerry Frank uses their firm as his accountants. As a shop owner, Gerry also loves numbers, and he brings a great perspective to the conversation. The highlight includes the new federal 20% deduction for qualified small business income. You'll learn more in a second. We cover a wide range of topics that may just show you how to keep some of your hard-earned money. Remember, please consult with a professional. Find the key talking points from this episode at remarkableresults.biz/A099. Now, let's talk taxes. Listen, I'm not an accountant, so I'm going to ask you guys to start from a perspective of a shop owner, guys, and I know that's one of your areas of expertise. Let's start about, your first talking point, a new 20% deduction for qualified small business income. Does that mean it's going down?
That means it's going down. In fact, that means that if you make $100,000 of profit, and if you happen to be a sole proprietor, a partnership, or an S corporation, you only have to pay taxes on $80,000 of it. So 20% of your profits are not subject to federal and income taxes. Could be subject to state, but not on federal income taxes. So that is a big plus for all small business owners if they are a sole proprietor, partnership, or an S corporation. The one that's excluded from this is if you happen to be a C corporation. So then most shop owners most of them are S corporations, sole proprietors, one-member LLCs, or their partnerships. In fact, across the United States, 34 million tax returns will qualify for this deduction.
Well, that's a big number. I would bet you that the majority of the service professional is going to fall there.
Absolutely. Just to give you an idea, the tax savings by having this deduction We have clients that making over $60,000 more profit this year than last year, and will pay about $23,000 less in taxes because of this. And that way we're sharing less with our business partner, Uncle Sam.
Yeah, that's exciting to hear. Now, Gerry, if that was your fortune, and it probably will be next year, does it allow you to invest in equipment, consider growing? I mean, what would an owner think about what to do with the money he didn't have to give Uncle Sam?
A lot of different things, I guess maybe I'd first start off with, if this is new to you, you should be having these conversations with your accountant or tax professional on a regular basis. It shouldn't be new. But, as the year comes to close, there's a lot of cool things on the horizon. And, what that means, you really want to sit down and have a one-to-one. I'm not an accountant. I don't play one on TV. That's why we rely on the professionals like Reed. But yeah, you got to get your ducks in a row here before the year ends.
Excellent. Now, let me ask all of you a question. If I realized I was coming into money, and that's probably not the right thing to say, but I had a lot less of a tax base, would I take some of that money that I wouldn't have given Uncle Sam and pay down debt?
Yeah, I mean, that's one of the things that we talk about when we go through this is, even though this is new this year, it's still going to be around for at least another 5 years, but it's not going to feel like new money after this year. It's going to become the new normal that you're used to. So one of the big things that we talk about is, what you decide to do with that money this year is really important, because it's going to kind of set the stage that, for what you have in future years. One of the big things that we talk about is we talk about to a lot of shop owners about retirement, and all too many times shop owners say, this is my retirement, right? I'm not putting money into a simple, I'm not putting into a 401k. I'm going to sell my business. What this is getting, like Reed just talked about, $24,000, a husband and wife can both max out their IRAs with that $24,000. Now you've set yourself up and you've set your money up that you're going to be maxing out for subsequent years to come. But you're exactly right. I mean, you have to decide what you're going to do now, because, a couple of years down the road, it's going to be like, hey, this is just what we are used to.
As you said, with the windfall money, you do have some choices. Paying down debt is not a bad idea. We would also say set some aside for a rainy day. Unfortunately, shop owners don't plan enough to keep enough cash aside for stuff happening. So save for a rainy day, retirement, paying down debt, absolutely great ideas.
Which is the reason to have professionals working for you in the form of attorneys, accountants, and other financial planners. I love the idea of putting money away for retirement. Okay, everyone in the audience, raise your hand if you've saved enough. I didn't see any hands go up. And you weren't the audience I was talking about. So, yeah, I think it's important to, and to your point, I have to tell you, Hunt, when I mentioned that pay down debt, I did not think of the fact that this year would be a windfall and the rest of the years would become the new normal. I never thought of that. So I guess there's a big decision to make here.
I think we got a question coming in. It says 80% of any amount or profit. So it's actually a 20% deduction. So if you make $100,000, you only have to pay tax on 80% of that because of that 20% deduction. And that's going to be profits, not sales.
Let's stretch that out. For example, what if it was $200,000? Then it would be on $40,000 less.
Correct.
That's correct.
Okay. So I think we're answering Tom Ham's question with that.
I want to add one more point. We mentioned the concept of the idea for small businesses, sole proprietors, partnerships, S corporations. It's also if you self-rent to your own shop, 20% of that we don't pay taxes on either. Okay, so self-rental also qualifies for this tax savings.
Are shop owners excited about this?
I think they should be. I know I got a little confession to make that Reed is also my accountant, so to be in the truth. But, we have those conversations, like we talked, those critical conversations. And I think it gets a little bit better. I know I had heard that, and not heard, it's a fact, 100% of your purchases or asset purchases can be deductible versus, expensing that out or depreciating that out. So, it's really a win-win this year for the shop owner. You had mentioned putting money away. I think I read some statistic recently that, the average small business could be out of, they only have enough money to really pay off a few weeks if things don't go right. I've been in business a long time where, I can remember where they closed the road in front of me for construction, and it was really difficult to get in and out of your shop. So putting together that little nest egg, if you will, to prepare for the hard times is really important. So that was a great point.
Hey, I'm with Brian Weeks from ATC Auto Center. Brian, why Jasper Engines and Transmissions?
So I think Jasper, the reason why we chose to deal primarily with Jasper is the quality of the product and the people. I know that it is a associate-owned company, but it's more about the people. They do what they do in this industry that is tough, and they stay on top of the cutting-edge engineering, changing and maybe developing ways around known problems and issues.
So they're adding value. They're making things better.
Oh, absolutely. Absolutely. They're taking a situation that you may have a common failure with and going in, taking it apart, going through the engineering, the R&D department and saying, okay, how can we make this better? And then from that standpoint, it comes to us that at the end of the day, the end user gets much more value for the dollar that they spend.
Hey, Brian, thanks for your time.
Carm, thank you.
Hey, I'm with Repair Pal certified shop owner Matthew Royayi from Auto Check Elite in Katy, Texas. Hey, Matthew.
Good morning. How are you?
I'm great. Repair Pal certified network, bringing you in a lot of business?
We get a lot of business from them, yes. I like the people that work there. I was the first certified shop probably in the whole Texas. I know for sure in Houston area. So I've been with them for a very long time. I use their estimator a lot. Their estimator is on my webpage. We don't give estimates over the phone. If they insist that they want an estimate, they can go to our webpage. We have a landing page just for estimates. It builds an estimate and we honor whatever that webpage says. There are times that is off $50, $100. I don't care. The amount of time we save by not just building estimates nonstop, it's very valuable to me.
Would you recommend Repair Pal to a friend?
Of course, I have. Many, many, many times.
To find out more information, go to repairpal.com/shops. Hey, Carm here, and I'm stopping for just a second to tell you to register for the December drawing for some special podcast swag. Go to remarkableresults.biz/swag and enter the password WISDOM. We'll draw in the first week of January 2019 for some really cool podcast collectibles. I want to go back to this 100% deduction thing, guys. Let's talk about that.
So one of the big things that we see in the past when we talk to our clients and said, hey, you are looking at a sizable balance due at the end of the year, what we heard a lot of times is, hey, I'd like to, redo my parking lot. My building is kind of aging. I, want to kind of take it into the 21st century. And so, we're talking about $50,000, maybe even $100,000 remodels. But unfortunately, we would say, you know what, that's good to spend for your business. But under the old tax laws, you're getting no deduction for that this year. Most of the time, we're depreciating over 39 years. So once I tell them that, they say, well, not only am I going to be out $50,000 to $100,000 in cash, I'm not going to get any benefit for it this year. And, a lot of shop owners are saying, maybe let's hold off on that. So one of the big things that we're excited about is, expanding this to include improvements and repairs to buildings, because it's going to let a lot of shop owners do stuff that they've always wanted to do. And now they can truly take the benefit of that. Like Gerry was saying, we also able to write off up to $1 million in assets this year, whether that's equipment, heavy trucks and stuff like that. We don't see that affecting a lot of shop owners because it used to be $500,000. We only have a handful of people that are buying more than that. Some of the big tow guys, if you buy a couple of trucks, if you really want to, you can be able to write all that off in 1 year.
Wait a minute. Are you talking about writing off an old asset or are you talking about depreciating it?
Depreciating and writing off are usually generally one and the same. Mm-hmm. So when the accounting term is depreciating, the layman's term is writing it off.
Got it.
All right. So if we in the past, where the old law says we could write off or depreciate all in 1 year, $500,000, it did bump up to $1 million. we're not all that excited about that concept of moving up to $1 million because it doesn't affect most of our small repair shop owners. But the plus is, as Hunt was saying, we now get to write off improvements, okay, such as if you do want to put a new roof, want to pave the parking lot. Those things we had to usually write off or depreciate over 39 years. Now we're getting it today.
I've seen an awful lot of shop owners show on Facebook their beautiful new showrooms.
Yeah.
And so that is 100% deductible.
If you would like to, yes.
If you would like to. Now, a question. It's a depreciated expense. Is that what you're saying, guys?
Correct.
So you have your choice, either depreciating it over time or taking it all today.
Got it. Does our industry understand that depreciation is a non-cash expense?
No. And so that's one of the big things that comes up is some of these times we have people that are getting, 10 or 15 year loans to help finance these large improvements, and they want to write off all of the amount this year. But what they don't realize is if you have this 10 or 15 year loan, you're not going to have any expenses to offset those payments that you have to be making for the next 10 to 15 years if you take all that depreciation this year. And so one of the big things is if you're paying this all with cash, fine, the cash is out. Let's make the expense or the depreciation match that outlay. But if you have a loan, then, you might have to weigh that thing. Does it make sense to pay a little bit of tax now so that I have the deduction in the future? It's kind of trying to put off that instant gratification of getting all the write-off right now today.
Got it.
Yeah, well, I want instant return,
Exactly.
And we all want that. I know for years, improvements, simple things. We had a conversation about the parking lot at my shop. For years I've been, sealing it and filling up those potholes. I'm from Cleveland, so we have that really tough winters come in and really tears up the pavement. And this year it made sense, rather than putting a couple $1,000s and making it look pretty, let's just replace the parking lot, which was a little over $20,000. And the way I look at that is Uncle Sam, my business partner, and Reed, you alluded to that, Uncle Sam kind of picked up the tab for 30+% of that parking lot. So it made sense to do it, rather than taking a little piece of that, being able to claim a small portion of that over a huge number of years. So, yeah.
Do the math on that 30% for us. Explain that. Is it because your tax rate was 30%? Is that what you're saying?
Sure. Yeah, absolutely.
Yeah. Okay.
Right. So it's like, Uncle Sam on a $20,000 parking lot, he's going to pay $6,000 of that parking lot for me. Really nice.
Wow. Now, number 2, expanded child independent tax credits.
I'm very excited about that because the tax law in the past allowed us a $1,000 tax credit for each of our children that were under the age of 17. All right. The new law says if they're under the age of 17, it's now $2,000. All right. So it moves from $1,000 to $2,000. That's good. But here's where it gets better. They widen the income that you could earn to qualify. A lot of times our clients, if they made over $110,000 in 2017, got a zero tax credit. Now, if they make over up to $400,000 as a married couple, they get the $2,000 tax credit. So that's really exciting, is we end up getting a lot larger credit for more people.
Basically, they moved up the level, the high income bracket.
Absolutely. From 110 to 400. So that's a lot of people that now qualify for it. And they added a new credit. Okay, so the old credit was for 17 and under. Now they added a new credit for people that are 18 and over. Okay, and it's a $500 credit. It's not as big, but hey, at least now the kids in college, you get a $500 credit, where in the past we got zero. All right, so that's a good thing. Or if your parents are your dependents, you get a $500 credit for them. If you have a nephew that's living in a house that's a slug and does nothing, you get a $500 credit for that nephew as well. So they expanded more chances to give you free money. Let's explain something that's really important here. A tax credit is better than a tax deduction. A credit is just like the government gave you cash. A deduction reduces the income. So the more credits you could get, it's just like Uncle Sam paying for the taxes. Hunt, you want to share your example of your one client?
Yeah, and so one of my clients in the past, he has 6 kids. He made about $225,000. And, everyone jokes about having kids and be like, oh, it's a write-off. But as Reed showed, if you're over $110,000, you were getting no credit. Most people didn't even realize that they weren't getting that child tax credit. But this client, he's going to get a $12,000 tax savings this year just from the kids alone.
Reed, you said tax credit is cash. So
yes.
If he's got 6 kids times 2,000, that's $12,000 coming off of his tax liability?
Yes.
Not reducing his income, but coming off his tax liability.
Yeah.
Wow, that's huge.
And a lot of that could be refunded as well.
So if he has a tax liability of $10,000, he gets the credit that wipes out that liability, and he gets some money back. Free money.
It's already worth it to have listened to this show today. I mean, my God, guys, it's like, here, I got bushels of cash to give you guys. and it was our Congress that did this, right? Yes. How do you see this, Gerry? As far as, are we telling our employees all this good stuff that's going on?
That's exactly what I was thinking, because, part of our duty really as a shop owner is to kind of up-level our employees, right? So you need to try to share this stuff with your employees, because usually they don't have the benefits that we do as shop owners, sitting down with professionals, talking to great folks like Reed and Hunt to kind of give them the inside scoop. But I think that most people really have no idea some of the benefits that they can deserve here or are entitled to in 2018 as it comes to a close.
I would assume, guys, in your accounting firm that you've duly reached out to all of your clients and said, hey, here's our newsletter. This is what you need to be prepared with. And if not, you did. But anyone who's listening that doesn't have a good accounting firm or hasn't been briefed, if you will, on all the things that are going on in 2018, get it done. Reach out, do it. Find a new accounting firm and, use this show to move you over the line.
That's a really good point, Carm, because I've been in the business now longer than I care to mention, probably 35 plus years. And for many years early on in business, I didn't have that power team, if you will, those accountants to sit down with to help me with those decisions. Listen, if the best advice I can give you, if you're not getting that important information from your accountant, early on in my career, I think my accountant was working for the IRS. I would only see him at tax time, and he would say, here's what you owe, and then panic sets in. So you need to sit down with your accountant and do some tax planning. He'll inform you of what's new. Do some forecasting, take advantage of the so-called loopholes, if you will. But that's what an accountant should really be giving you. Tax advice, not a tax bill.
I love what you say, your power team. And I know it's accountant. I know it's an attorney, but it's also a banker, right, Gerry?
Yeah, for sure. When we decided to move locations many years ago, I had I felt I was in good standing with the bank and all of that. And guess what? I went to the bank and they said no. And it really kind of opened my eyes up. Now I have relationships with several bankers. So, I feel like you're in a really good position. So yeah, everybody needs to have a great banker, great accountant, and a great an attorney as well.
Hunt, Reed, number 3, expanded Section 179 and bonus depreciation rules. Now that sounds really accountant-like.
Well, we actually kind of talked a lot about that already when we talked about writing off equipment and or leasehold improvements. So we really kind of hit that a little early on. We actually jumped from 1 right into 3, if you want to be honest. Yeah. I would like to dovetail back a little bit to a comment Gerry made mention about educating your team members on tax law changes. All the technicians that used to write off their equipment or tools and their uniforms and stuff like that will not be able to do that this year. So the new tax law eliminated employee business expenses. So here's an opportunity to teach your technicians that the write-off of their old tools or the tools that they were buying are not a benefit for them. This is now an opportunity for a business owner to think of a way to take care of their technicians and maybe reimbursing them a little bit more for their tools in lieu of maybe raises per se. So that way, because the employee can't write off, but the business still could write off those tools. Am I making some sense there?
Yeah, you're making all kinds of sense. We've had dialogues on this show and on the podcasts about buying technicians' tools and, building the kind of equipment base in the shop that prevents, your guy spending all the time on the tool truck, and let it kind of, if you will, be a retention piece that, you've got all those tools. So if he's spending $200, I don't know, a week, a month, or whatever on the tool truck, you're saying on his personal income tax, he can't deduct that.
He can't deduct that. Yeah. In the old law, he could, but now he can't. So any employee business related expense that they have, if they were paying their home internet because they were doing researches and stuff like that and working on getting certified and stuff like that, that is all gone.
What's the reasoning for all of that? You got any idea why that was taken away?
It was honestly an extremely abused area of people's taxes. Just as likely as someone to deduct, legitimate expenses for tools and uniforms, we had people that just kind of went a bit overboard with it. So that, I think, is one side of it. And I believe another side is to also push some of this back onto the businesses, saying, hey, if you're going to require this person to come here and do the job, you're actually pushing the cost of doing his job onto them. And so maybe a bit of pushback to try and get the corporations or the business owners to, start picking up some of that tab.
What a great opportunity, though, for your technicians as a shop owner. Now you can actually purchase their tools. If I understand you correctly, guys, we can purchase their tools, give them a great spiff, right? Something that nobody else is doing, and we get to write it off. So, think about the benefits of that. You're going to have a technician that's going to stay with you, because I don't think, I got to say, most of the shops up and down the street aren't aware of this. Mm-hmm. So, think about how that in today's really tough economy, when we all know the technician shortages and things that out there, it's just one more feather you can put on your hat that might make a technician choose you instead of the competition.
So how many techs knew that they could deduct their tool purchases?
In the past, I would say a lot of them knew they could deduct it in the past. We've been fortunate with our practice. We've done a lot of tax returns for employees of our clients, as well as employees to dealerships along the way, and they were all writing those items off. And when we did their tax return this year, we showed them their tax return without that happening. So all of our clients were pre-educated along the way. And by the way, just to jump back on, also something Gerry talked about is tax planning. April 15th is not the day to do tax planning, just so everybody knows that. The best time probably is in September, October, when the accountants are a little less busy and we can stay focused on your conversation and your business a little bit more. Just for a word to the wise.
Wow, Gerry, he brings up such an important idea. How many shop owners out there are sitting down with their professional accounting team saying, okay, let's plan what's going on this year. Can I still do something that will have a positive tax implication for me yet for the rest of the year?
Yeah, that's why it's so important, Carm. Usually you get hit with that surprise, right? In April, or maybe a little bit before then. And then, most people don't put aside that money. They're faced panic on their face and all of that. It shouldn't be a surprise. You should be planning for it all year.
You told me I made money. There's no cash in the bank. You told me I have to pay taxes. There's no cash in the bank. How could I pay taxes when I don't have any money?
Yeah, where did it go?
Exactly.
And that's one of the things you really need to partner with your.
And I do want to talk, I want to talk about that with you at the end, Gerry, about the Profit First book, okay? We'll talk about that. Number 4, hey guys, thanks. That was great. I think we may have opened a whole lot of minds with the technician piece. And by the way, Gerry, I love your idea. What an opportunity for the shop owner to do something for his people and do it for all the right reasons. Maybe this is the move that will take this new business model, tool buying model, to the next level. Guys, number 4 on your list was new lower tax rates and tax brackets. Sounds like the summary of everything that's going on.
Yeah, and so one of the things that we heard a lot, or like depending on which news station you're listening to, is that this was a tax break only for the rich, right? That no one was affected. While that is true, the top tax rate went from almost 40% down to 37%, so almost a 3% decrease. But we're seeing roughly a 3% decrease across most brackets. So really every income level, we're seeing decreases. One of the biggest changes, though, is not only did they change the amount of tax in those brackets, they expanded some of those. So in the past, if you were making over $230,000, you would have already been up in the 33% tax bracket. Now that same tax bracket or that same area of income is 24%, and it goes up to $300,000. So you can see how not only are the actual rates lowered, these buckets are getting bigger. So kind of the sweet spot where we see a lot of business owners falling is it takes a lot more to get into those higher tax brackets.
The word rich is such a relative term. I mean, somebody having a double income family making $250,000 is, it's there, but it doesn't mean that they're rich. They're actually spending every dime they make, right? And so it's not rich. It's not like making $1 million a year.
No, and that bracket, why we were so excited about that one is that, $140,000 to $300,000 is where I would say 75% of, our successful business owners clients fall into. We're not talking about people that are having $800,000, $1 million in, AGI. It's just not very common. And so that's kind of the area, the sweet spot that we were really worried about. And we really kind of wanted to go down through and say, hey, we heard a lot of talk about this. There's a lot of numbers being thrown around. Let's really see how it's affecting, small business owners.
I love it. Gerry's going to make an impact on you.
Well, yeah, of course. I want to go back to that rich statement and kind of think from the employee's term, because I think so many times our employees think that we're rich. You've got a shop that's doing $1 million and they think you're a millionaire. So the more transparent we can be with those numbers, it benefits everybody. I love to really be in my shop. I'm transparent with the majority of the numbers, and it gets everybody kind of fighting for that common goal.
Guys, Gerry brings up such a great point. Would you guys ever encourage your clients to share the P&L with their people?
Yeah, we encourage our clients to share the PRL because more often than not, at least a strong portion of the PRL, the things that they can definitely control, involved with the sales, the cost of goods, some of the expenses. As a business owner, some stuff you might not want to share, but overall, you got to share a decent amount with them because they're the key that's going to help you make more money. And the more you get your PRL more in line with your POS, that also helps along the way because most team members believe the numbers of the POS. So if we could get the POS showing the proper percentages and stuff like that, that will definitely help the team members help improve your business as well. So getting them to believe the POS, showing them part of the PRL, absolutely definitely helps.
Can I jump in real quick there? I heard you say PRL, and I've known you read for a long time. It's P or L, right? It's profit or loss. It's not profit and loss. And the other thing you mentioned, huge point, was just briefly making sure your sales system, whatever your POS is, whatever your management system is, matches what your profit and loss statement says. Sometimes people are looking at that, that business summary or the report from their management system, and the numbers aren't accurate.
It's so funny. I'm going to stand corrected, guys. Thank you so much because I'm listening to Reed say PRL, and I'm thinking, okay, he knows what he's saying. I don't, and for my whole life I've said P&L. My whole life, own my own businesses, the whole thing. I've had a P&L. And so, Gerry, just like you, I stand corrected. You're right. It's profit or loss. It's not profit and loss. Wow.
Yeah. And so just like Gerry was alluding to, a lot of times kind of that perception of your employees thinking that you're making all this money. Yeah. Once you start opening their eyes to the financial side of things, you can see how quickly, even that $1,000 repair ticket goes away to not a whole lot be left afterwards. Especially if your point of sale is set up incorrectly. You're setting goals for your employees to hit a certain target, and they're saying, boss, we're making 85%, gross profit margin on this job. Everyone knows that's not accurate, but when they're looking at it, all the stuff that's in their face, all the tools that they're using, it's right according to them. So, once we start getting these two systems matching and everyone on the same page, you say, hey, you know what, that same $1,000 job that you think I'm making $850, I'm walking away with $400, maybe $500. Then I still have to pay for everything else you see around here. I think that buy-in kind of shows some of the employees of like, hey, you know what, there's a little bit more to it than just paying for your parts vendors and moving on.
That's probably the biggest, most impactful thing we could teach our people, that we have to pay bills out of gross margin, gross profit, whatever words we want to use. And you're right. At the end of the day, God bless the shop owner for making 20%. But, then there's the other story. What does he do with that 20%? I mean, he's investing in the business. He's offering raises. I mean, you still then you have to pull things from that bottom line. And yeah, I think there's a romance from a lot of people saying, wow, I want to go into business. This is so cool. And I could be rich.
One of the things that I often I share with my team members, because they don't understand it. And I've done this in front of a live audience many times. I take a dollar bill, and they don't understand. They think every single dollar bill that comes in the door goes directly in your pocket. And they don't realize the expenses and how little of that the shop owner keeps. And I know it's probably a crime, right, to rip that dollar bill, but a big portion of it goes to the parts store. We got to pay for the parts. Big portion of it goes to you guys. I got to pay your salary. 25% of that's going towards my expenses and so forth. And what's left is this little corner, and it's not a whole lot. And the more you can make your folks understand how important that profitability is, we're all on the same team working for the common goal.
Guys, I want to get back to you, but I have to bookend what Gerry just said. I did a seminar just like that myself, Gerry, but I used $100.
Oh, I could never do that.
No, Gerry. No, here's what I did. I took $100 in cash in $1 bills, and I divided the money up into cost of goods, into payroll, into benefits, and there was envelopes, and the envelopes were attached underneath the seats in the first row. So when I started to get into the financial piece, I asked everyone to get up and look under their seats, and everybody in the front row had an envelope, which was if you come to Carm's seminars and you sat in the first row, then there's a benefit. We started the P&L up top. Of course, that fictitious, there's $100 sitting out in the audience, and that's the sale. And we kept breaking it down, and our cost of goods was the biggest amount in the envelope. And that person, we said, you're going to go to the bar tonight and, buy drinks for all of us. And, that's not my money. And my money, I think there were $4 in the net profit envelope. And then we talked about what do you do with that money? And so there's this person sitting here with the least amount, and that was the NP, or the net profit envelope. So I love it. I think it's a great way, even for a shop owner, to get his people together and flow his P&L out into, if you will, plates, buckets, accounts, envelopes. And I'm saying this because we're talking about accounting and profit here today, which is so cool. Maybe somebody will pick up on that and do it.
I typically use it as a funnel, and you look at things as a funnel, and the rest of what money drops down to the owner. And if we could widen the funnel, improve maybe our gross profit, a little more drops down to the owner's pocket along the way.
Yeah. And I know I was going to just add, so many people think the number side or the financial side is boring. You're not a numbers person, but I think the SBA says something on their websites like 7 out of 10 small businesses fail in the first 5 years. And why is that? I say financial incompetence. A better way of saying that is they just plain run out of money, right? So, the more you can share that with and get you as a business owner, as a shop owner, you've got a duty to your people. A lot of people are counting on you. You need to understand a little bit of the financial numbers.
Got it. Great. By the way, Gerry, you wanted to talk about entertainment deductions. Guys, talk to me about entertainment. I'm gonna take my customers out to the ball game. Can I deduct that?
Well, you could take them out to the ball game and have a good time, but you cannot deduct it anymore. No clubs, no ball games, no fun stuff like that is a allowable deduction. In fact, if you use QuickBooks for your accounting, you could might as well delete the thing that says entertainment, because all entertainment is gone. Still could deduct meals, 50% of those, possibly 100% for certain items, but entertainment, again, just as Hunt talked about the abuse that individuals did under employee business related expenses, big businesses like Coca-Cola, IBM, you see them with all their suites at sporting events, and we're taking advantage of that, and now are all gone. So all that entertainment is gone.
So you mean to tell me, and let's take Coca-Cola, for example. They're sponsoring a golf outing, and they're going to spend $1 million on suites and all this really cool stuff. It's on the P&L, but they cannot use it as a deduction?
Correct. So no longer, but in the past, what we were doing as taxpayers, we were actually subsidizing all of them because they were able to deduct that stuff in the past. So, when Coca-Cola had private, events where all the executives could go play golf, or maybe they rented out a skybox at the Super Bowl, we were covering that cost as taxpayers. And so the entertainment side of things, we don't see a ton of entertainment expense for small businesses, shop owners that we work with. Some of them do have it, where they maybe have season tickets and stuff like that. I wouldn't say it's a huge bang for, small business owners. It's really, to try and curtail some of these, multi-million-dollar corporations that are just, essentially going out and having fun on our expense.
One thing I would add to that, though, is so many times as a small business owner, we have that, it's called a chart of accounts in QuickBooks. And whether QuickBooks provides you with that or you've had it for years, there's an entertainment account. And people may just drop things in there. Potentially meetings. Maybe you're having a meeting on site with your staff and you're bringing in lunch and things like that. Reed mentioned something really important, and it's a writer down there. If you have entertainment as a category in your chart of accounts, strike it from that. Find some place to put it.
Yeah, and to the point, if I was going to have a 60th anniversary open house for the community, my customers, it's an allowable deduction as long as it doesn't say entertainment.
Correct.
And that's one of the big things is that if the IRS comes and they looks at your financials, the standard verbiage is meals and entertainment, where in the past we were okay with that because both of those were 50% deductible. But if the IRS looks and they see that word entertainment on anything, they're going to say, we can't prove what it is. We're going to throw all of that out. So that verbiage just needs to be completely off of your finances.
Okay, guys, I'm going to hold an off-site meeting for my team. We're introducing a brand new culture inside the business, and we want this to be done right. So we're going to take a weekend at a resort. Is that meeting expense? Tell me where I would put that.
That would be true. That would be a meeting expense. Still, that's not entertainment. That's not like you going to a show or a sporting event or going to a country club and going golfing, okay? So those are the things that they decided they want to kibosh.
Got it.
You having meetings with your team members, or you having a holiday party or a summer cookout, you still get all those. That's not a problem with that at all.
Okay.
It's if you decide to go to a sporting event or something that you, quote unquote, are going to have fun and entertained and be watching.
The no fun rule. If you're having fun, it's probably not deductible anymore.
The no fun rule. I love that. Okay. All right. Well, that's simple enough to remember. Damn.
And again, it doesn't help. It doesn't usually affect much of our small businesses. Definitely, this is going after the Coca-Colas, the IBMs, the Exxons. And what this means for them is they're going to end up paying 21% taxes on this money that they can no longer deduct, even though they're still probably going to be spending it.
Well, I love what you said, that we were funding it. I mean, if those dollars were coming into our tax-based coffers, then taxes had to go up for everybody in order to pay for our government. Well, I love this. Listen, I want to move into the book that Gerry would love to talk about for a few minutes, guys. And please stay and join in this conversation. Is there anything else that creams up to the top in the new tax law that we need to know about or talk about?
The big hits with the lower rates, just giving you examples. Our clients are increasing their taxable income and their tax burden is going down. So I will tell you this, if you found tax returns, get your accountant to compare last year to this year to show the changes you're going to find, even if your income went up and your taxes went up, it didn't go up the same way. It went like this way, okay? So it went down along the way. So it's going to be, you'll be very excited when you get your taxes done this year. For a change, I don't get to be the Grinch, and I get to be Santa Claus giving the good information here.
Ho, ho, ho. Excellent. Gerry, you talked to me about the book Profit First from Mike Michalowicz.
Yeah, literally changed my life. Probably 3-4 years ago. I don't know when the book came out, but most business owners take a look at. I got my copy too. It's a little bit of a different version, but again, what a great book.
I'm reading this right now. I can't put it down.
Yeah, and basically, the premise of the book is, let's face it, if you want to lose weight, one of the key fundamental things you can do is get a smaller plate. I know, and I'm sure many of our listeners know, if I go to a buffet and they have those giant plates, we end up eating too much, right? We eat everything that's in there. And consequently, it's the same thing in business. You have your bank account, which is kind of a big plate, and you pretty much spend everything that's in it. And it's crazy how that works. The more we do in sales, it seems like the more we spend. And a lot of times, maybe there's an accountant's term for that. Reed or Hunt, you would share with me, but we run the business by our bank balance. And you say, well, there's $30,000 left in the bank. I'm doing just fine. But that $30,000 isn't all yours. Uncle Sam wants a piece of that. The parts guy wants a piece of that. You got to pay your parts bill, your employees. You got rent. If you really knew what small percentage of that bank account was yours, you'd probably have some sleepless nights over it.
The thing I loved about the book is you need to have all these different accounts open. And part of the concept, Gerry, was when the revenue came in, you immediately started to move your money into those holding accounts, your Uncle Sam account. And at the end of the day, then you have an operating account. And here's the premise of the book, guys, that I loved so much, is if you can't pay bills with the operating account, then you got a problem. Because you've already allocated the money that is guaranteed. I mean, there needs to be a profit account, there needs to be an owner account, there needs to be a tax account, and there's some other accounts. And in concept, we were always wondering when we ran out of money, what did we do wrong? Oh my God, well, let's go out and push revenue. Revenue comes in, there's money in the bank, and we have this vicious cycle. And that's the part I love about the book. If you can't pay bills out of the operating account, then you have a problem in the expense side and or the sales side or in the gross margin side, but you're not stealing from Peter to pay Paul.
Yeah, boy, how nice would it be at the end of the year to know come April 15th that you already have all your tax money set aside. And that's one of the great things about the book. So I don't want to steal all the thunder from the book, but you'd mentioned, Carmen, breaks it into small different accounts. So you have that main income account where all your customer money flows into, and then you're dispersing it to other accounts. And the title of the book, Profit First. So you want to pay yourself first. So you set that money aside in your profit account. And then you've got to pay your expenses. Well, next comes Uncle Sam because he's our business partner. So you have to pay Uncle Sam. And then you've got your expense account. And as you mentioned, that expense account usually ends up being that small account, and you have to be able to make your bills work with that. And it takes some discipline to be able to do it. But if you can do it, it will set you free financially.
I have a goal to have Mike on my show. While this was great, I really think not only did we open the eyes of the new tax law, but we went even deeper. And, I have to thank Reed Melis, financial therapist. And yeah, I can see how you are and would be. And a partner at Paar Melis and Associates, along with Hunt Demarest, CPA at Paar Melis. Obviously, they're in the same picture together. Beautiful woodwork there. I love that. They're in Mount Airy, Maryland. And that's what's interesting, Gerry. You're in Cleveland and they're in Maryland, and yet they're your accountants.
Yeah, Reed and I met many years ago at a conference, and their firm, not a commercial for them, but their firm kind of specializes in auto repair. So it was, again, finding that person that can really help me with some financial advice instead of just sending me the tax bill at the end of the year.
I mean, I think that's a profound thought. You don't necessarily have to have an accountant in the same town or the same community. I believe in that. Great to see face-to-face every once in a while, but with our new technology today, like what we're doing, I mean, this is as good as face-to-face as you could possibly get.
One of the things that we hear a lot of times from new clients too is, we might have a client in Washington State and they say, you know what, you guys are easier to get a hold of than my person that's down the street, because a lot of times the only way that they were able to get a hold of their accountant was to physically walk in their office. But for us, since we are doing everything virtual, communication is huge for us. You'll always be able to call, email, text, whatever it might be, because we know that that's our strength. We're not selling a product, we're selling our knowledge and our advice. And if you're not getting that out of your accountant right now, then you need to make a switch, because, that's what we're here to do. We're not here to serve ourselves. We're here to, help our customers answer questions, help them grow, and then help them hopefully grow and keep more of that money in their pocket.
Yeah, no, absolutely. It's worked for me. Again, really get somebody that knows what they're doing. Create that power team. Make sure you got that banker, that attorney, and for our conversation today, a strong accountant that can really help guide you with some of that stuff.
Well, thank you to Gerry Frank, shop owner and business coach at Repair Shop Coach, Cleveland. How long you been in business, Gerry?
Oh, long time, 35 years. I kind of mentioned in my notes when I started in the business, there was full service. Gas was about 70 cents a gallon, and we gave Eagle stamps. So a long time.
Thank you all so much for being here. I appreciate it. The impact of the new tax law on the service professional here on Week 99. Bye, guys.
Thanks for being on board to listen and learn from the premier automotive aftermarket podcast. Until next time.